So what if the next housing crash isn't just some remote possibility? What if it's a statistical probability? What if the echoes of 2008 are a whole lot louder than anyone's willing to admit? Today, we are going to unpack a really powerful market analysis that's been making the rounds, one that makes the incredibly bold claim that the U.S. housing market is teetering on the edge of a truly historic downturn. The source we're digging into argues this isn't going to be some minor correction, but a crash that could actually dwarf the great financial crisis. So over the next few minutes, we're going to go deep, slide by slide, into the evidence, the startling data, the economic warning signs, and the strategies proposed by this forecast to give you a full 360-degree view of this provocative thesis. But before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
All right, so here's the game plan for how we're going to break this all down. First up, we'll explore the main argument, this tale of two bubbles, comparing what's driving the market today versus back in 2008. Then we get into the real meat of the analysis, the echoes of the 2008 crash, and trust me, some of these numbers are absolutely eye-opening. From there, we'll zoom out and look at the economic red flags waving all across the country. Then we'll pivot from the hard numbers to human behavior in the psychology of a downturn. Once we understand the problem as it's laid out, we'll look at the playbook for navigating the turbulent market, and finally, we'll wrap it all up with the final takeaway.
Okay, let's get right into it. The entire foundation of this analysis really challenges that one phrase you hear over and over again: this time is different. The source we're looking at argues that, well, maybe the causes are different, but the end result could be a brutal financial déjà vu of 2008, and maybe even on a bigger scale. The core argument is that we're not just in some run-of-the-mill housing bubble. We're in a historic one, defined by this insane, almost overnight explosion in home values that blew past even the frenzy we saw leading up to the last big one.
Now, this slide right here draws a really critical distinction. It puts a very clear line in the sand. On one side, you've got the 2008 bubble. Everyone pretty much agrees this was fueled by loose lending. Subprime mortgages, ninja loans, no income, no job, all of that stuff. It was a crisis that was really born from a total breakdown in lending standards. But on the other side, this analysis argues that the current bubble has a totally different DNA. It's said to be the result of an artificially supercharged market. Think about it. In response to the pandemic, trillions of dollars got pumped into the economy, and interest rates were slashed to basically zero. According to the source, this created a massive, unsustainable fever in the housing market with no real organic economic growth to back it up. The argument is that if the Fed had raised interest rates sooner, maybe they could have let some air out of the bubble gently, but that's not what happened.
But look, this isn't just about theories or pointing fingers. This is where the rubber meets the road. The analysis backs up these claims with some pretty shocking numbers. This next section is where the argument really starts to hit home, because the data suggests the parallels between then and now, well, they're just too big to ignore. Let's take a look.
First things first, we need to set a baseline. We got to understand the sheer scale of the last boom. So, during that period of absolute market insanity leading up to the 2008 crash, about 25 million homes were sold in the U.S. That number represents the total volume of deals, the total number of mortgages written during the absolute peak of that bubble. I want you to burn that number into your brain, 25 million.
Okay, so what was the fallout? Of those 25 million homes sold, what was the actual damage? Well, the data shows that about 2.8 million of them eventually went into foreclosure. Now, you might think that's only a little over 10%, but you have to understand the gravity of that number. That 2.8 million was the spark that lit the fuse. It was enough to trigger the great financial crisis, a recession that vaporized trillions in wealth and nearly brought the entire global economy to its knees. And it's not just numbers, right? That crisis had a massive human cost. Millions of families lost everything. That's the scale of the impact we're talking about here.
So with that history lesson in mind, let's fast forward to today. According to the source material, if you add up all the homes that were sold during this recent pandemic-fueled buying frenzy, you get a number that is hauntingly familiar. Approximately 25 million homes were sold during the peak of this current bubble. It's a near-perfect mirror image. People piled into the market, driven by cheap money and a massive fear of missing out, creating the exact same transaction volume we saw right before the last big collapse. The scale is identical.
And this right here is the slide that should make everyone stop and think. This is maybe the most alarming piece of data in the entire analysis. We've established the volume is the same in both bubbles, 25 million homes, but as of right now, today, the source claims there are already about 2.5 million mortgages that are either delinquent, meaning they're behind on payments, or are considered at serious risk of becoming delinquent. Just let that sink in for a second.
We are already mirroring the total number of foreclosures that blew up the economy in 2008, and we're not even in an official recession yet. So if 2.8 million eventual foreclosures caused a global meltdown, what in the world could happen with 2.5 million mortgages already on the ropes before the real economic pain even starts?
And when you see it all laid out like this, side by side, man, the core of the argument just stares you right in the face. Let's just walk through this because the parallels are just chilling. First row, homes sold. 25 million in the 2008 era, 25 million in the current bubble. It's a wash. The market exposure is identical. Second row, eventual foreclosures. We know how that story ended last time, 2.8 million. For the current bubble, that number is the big TBD, to be determined. But then you look at that third row, current delinquencies. As of today, the source puts that number at 2.5 million mortgages already in trouble. The number of at-risk loans today is nearly the same as the total number of failed loans that caused the last crisis. And finally, the economic context. Both scenarios are set in a pre-recession environment. It's hard to look at this and not see a terrifyingly similar stage being set.
But of course, the housing market doesn't exist in a silo, right? It's all connected to the health of the broader economy and, maybe more importantly, the financial health of the average American family. And according to this analysis, when you zoom out from just the housing data, you see a whole bunch of other red flags waving, suggesting the foundation under our feet is a lot shakier than most people think.
One of the biggest factors here is what the source calls the affordability crisis. And this isn't just about houses being expensive. It's about a fundamental shift in who can even participate in the market. The analysis paints a pretty bleak picture. It used to be a cornerstone of the American dream that one decent middle-class income could support a family and buy a home. Forget about that now. Today, to buy even a modest starter home in many parts of the country, you need 2 high-wage earners, and you still need a pile of cash for a down payment. This reality stretches family budgets to the absolute breaking point, leaving them with zero margin for error. A single job loss, one unexpected medical bill, and the whole house of cards could come tumbling down.
The analysis then points to these other major warning signs for the average person, and it really paints a picture of a household that is just financially fragile. Let's break these down. First, the U.S. savings rate is at an all-time low. The stimulus checks that padded everyone's bank accounts for a while, yeah, that money's gone. What does that mean? It means there's no safety net. Zero. The financial tightrope people are walking on has no net underneath it. So to make up for that, what are people doing? Second point, U.S. consumer debt, especially that killer high-interest credit card debt, is at an all-time high. People are swiping plastic just to maintain the lifestyle they got used to. That is a recipe for disaster. Third, there's a psychological piece to this. The source argues people are really hesitant to downgrade their lifestyle, so they'll go deeper into debt before they cut back, making their situation even worse. And finally, a really interesting market indicator, the short-term vacation rental market. All those Airbnbs that were a super popular investment during the boom is now reportedly tanking. That's a huge signal that the speculative fever is breaking, and a lot of people who leveraged up to buy multiple properties could be in a world of hurt very, very soon. All right, we're about halfway through our breakdown, and we're getting into some heavy stuff here. This is a good moment to pause. If you're finding this explainer insightful, please take a moment to like this video and subscribe to the channel. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
So far, we've talked a lot about hard data, economic indicators, spreadsheets. But what if the biggest threat to the market isn't found in an Excel file, but inside our own heads? This next part of the analysis explores a really powerful, intangible force, our collective belief system, and how widespread public fear can actually become a reality-bending force in the economy.
So, to get a read on what people are actually thinking, the source for this analysis did something pretty simple. They ran a poll on their YouTube community page. The question couldn't have been more direct. Will there be another foreclosure crisis? They just put it out there to their audience, a group of people who are already actively thinking about and following the real estate market.
And the results, well, they speak for themselves. They were absolutely overwhelming. A massive 78% of the people who responded believe that yes, another foreclosure crisis is coming. Only a tiny minority, just 22%, were optimistic. Now look, this is an informal poll, it's not a scientific study, but it's a powerful indicator of a widespread, deeply held belief that trouble is right around the corner.
And this is where it gets a little spooky, because this is the key insight from that poll, according to the source. This isn't just a fun fact, it's a potential catalyst. The argument is that fear on this scale can become a self-fulfilling prophecy. You know, it's like a classic run on the banks. If enough people believe a bank is going to fail, they all rush to pull their money out. And what happens? Their collective action actually causes the bank to fail. The same principle could apply here. When almost 80% of people expect a crisis, they start acting differently. Even financially stable families start pinching pennies and saving more. Businesses get nervous and delay hiring. This collective pullback sucks energy out of the economy, which can lead to layoffs, which can lead to, you guessed it, the very foreclosure crisis everyone was afraid of in the first place. Belief can literally create its own reality.
Okay, so if this is the potential storm on the horizon, this mix of scary data, a fragile economy, and negative public belief, what do you actually do about it? Well, the analysis doesn't just ring the alarm bell and walk away. It offers a very specific playbook with real, actionable advice for both sellers and buyers who have to make a move in this crazy market right now.
For anyone trying to sell their home right now, the advice is blunt. The party's over. Be aggressive and be realistic. The source argues that those euphoric days of putting a sign in the yard and getting a dozen offers over asking price are done. The goal now is just to get a successful sale, not to win the lottery. So, step 1, identify your real competition. What other homes are for sale right now in your neighborhood and price range? Step 2, price your home to decisively beat them. That means getting ahead of the market, not chasing it down with a little price cut every 3 weeks. And for those in the tough situation of being underwater, where you owe more than your house is worth, step 3 is to seriously consider a short sale. That's when your bank agrees to let you sell for less than you owe. It's a tough road, but the analysis suggests it's a whole lot better than waiting around for the bank to foreclose.
Now, for buyers, the message is the complete opposite. Your mantra should be patience. Be methodical. Be unemotional. According to this analysis, the power is shifting back to you. Step 1 is to kick the tires and shake the trees. That means do your homework, do your inspections, be exhaustive. Step 2, write offers. Even lowball offers. Test the water, see how motivated or maybe even how desperate a seller really is. And step 3 is probably the most important rule in the book. Do not fall in love with a property. The second you get emotionally attached is the second you lose all your leverage. In a buyer's market, the person who's most willing to walk away from the table is the person who holds all the cards. Be ready to let a house or two go to find the right deal.
So after all of this, after all the data, the economic context, the psychology, the playbooks, what's the bottom line? What's the one single thing we should all walk away with from this entire analysis?
And it all comes down to this single idea. The source doesn't end with a 100% guarantee of doom and gloom. It ends with a really powerful and pragmatic emphasis on just being prepared. This quote says it all. The point here isn't to scare you, is to empower you with information so you can make smart decisions for your own financial future. The goal isn't to be a doomsayer just for the heck of it, it's a call to action to protect yourself and your family whatever happens. The goal is to avoid being a deer in the headlights if this scenario actually plays out.
And that leaves us with this one final, really unsettling question that hangs over this entire analysis. There's a general rule in markets. Bigger bubbles usually lead to bigger blowbacks. The higher the climb, the harder the fall. So given that this analysis makes a pretty strong case that this last housing bubble was even bigger, even faster, and even more extreme than the one that led to 2008, the question is our financial system, and are we as individuals, truly ready for what might be coming if that rule holds true this time? That concludes our breakdown of this very compelling market forecast. Let us know what you think down in the comments. And before you go, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Thanks for watching.